Okay, so I will try to get through this lecture. Hopefully you don't cough too bad while I'm talking here, but if I do, I apologize. We're going to talk a little bit about Chapter 14, which is tax consequences of home ownership. And I did want to say, I think I wanted to mention this in class before. I don't think I actually did. Um, well, I'm not even going to talk about it. I changed my mind. Sorry. Sorry to keep you guessing there, but let's get into the material. Okay, so when we're talking about the tax implications of home ownership, the tax code defines this I don't know a better way of saying it other than just using their terminology, but dwelling unit is basically what they are granting a um, a tax benefit on. So this is one of those situations where, for public policy reasons, the IRS and I guess ultimately Congress decided that this was something that was important to encourage homeownership. And so, I don't know, you guys all might be too young, but when I was growing up, you heard a lot of people talk about the quote-unquote American dream. I don't hear that as much, or at least I haven't noticed as much since I've been an adult, so most of y'all's life. But anyway, for public policy reasons, we want to protect and encourage homeownership as a desirable thing that, I don't know, maybe promotes stability or something else within the country. So because of that, we grant it special tax privileges. So first step in determining, in looking at, I should say, I guess, how this works is determining what all is considered a dwelling unit, which is what is actually getting this exempt status. So you've got a list here. Obviously, home would be the one that we're most commonly talking about. That would include condos, apartments, etc. Or I guess a condo would be an owned apartment. Anyway, but it would also include a mobile boat. And what they mean by that is not a speedboat, of course, but like a houseboat or some other boat that has a cabin that you're actually living in and you can prove that you're living in. And then once you've determined that you have a dwelling unit, it's also important to know, well, what is this used for? Personal use only, mixture of rental and personal use, which would be a mixture of personal and business, essentially. Or is it solely for rental purposes? Whether it's considered a residence or non-residence, or essentially whether this dwelling unit is going to benefit from the public policy decision to make owning a house a tax favorable position, that's going to hinge on the purposes for which this is used once you get past that dwelling unit test. So once you've determined that it is a dwelling unit, we then need to look, like I said, at what it's actually used for. So personal use days is more than the greater of 14 days or 10% of rental days during the year. So if personal use days are greater than that, then we consider this unit a residence. Okay, that just means it has some residential value to the owner, is basically what the terminology residence means. And if it's not a residence at all, then there are some tax benefits from it, but they are more of the expenses, like, okay, if you're paying utility costs or whatever else, other costs associated with getting the property ready for someone to live in. That type of thing is able to be written off if it's a non-residence, just a rental unit. Whereas we're looking at a different type of tax benefit when we are looking at home ownership in general, and more specifically dwelling unit ownership, I guess, or residence ownership. Okay, so when defining those, whether or not we meet that threshold of personal days, well, what is a personal day? That's any day a taxpayer or other owner stays in the home. Basically, if a relative stays in the home, we're still considering that a personal day, even if they pay for it, just because we're saying that a relative, essentially we're saying a relative cannot have an arm's length transaction from another relative. There's always some underlying thing that we don't know about. That's kind of the IRS assumption. Yeah, this, sorry. This is not what this was supposed to say. In fact, the days a non-owner stays in a home under vacation hoe exchange are not what we're actually talking about here. No, this is home exchange. There should be an M there. So yeah, if some stranger's staying in your house because they're letting you stay in their house, a house swap, that is still considered you using the house. And then any days the taxpayer rents out property for less than fair market value. And we say that because we just assume that if it's for less than fair market value, there's some reason for that. So it's probably not an arm's length transaction. So rental days would include any time the property rents at fair market value, and any time there are maintenance or repair days strictly associated with that rental use. So like cleaning after a tenant leaves, or repainting or recarpeting or anything like that. You just don't count any days that are neither, essentially. That's what the last bullet point there says. So you're just basically comparing personal versus non-personal, and it doesn't necessarily have to be out of 365 days. Okay, for any given year, if you've determined that you have a dwelling unit, it could be a residence or a non-residence. Well, if it's a residence, it could be either a principal residence or some other residence. I know most of us mortals just have the one, but obviously you've probably seen examples of celebrities or people with a lot of money that you know or are friends with, or maybe there are some of you that have that much money, and you have a principal residence where you spend most of your time, or just what you consider headquarters, if you split time evenly between all of them. And then you have others. So you can only have one principal residence. So why do we care? Well, these check boxes tell us all of the benefits that are associated with each of these statuses. And you can see that they share some of them. Real property taxes are shared between all of them. Exclusion of gain on sale of home to some extent, depending on what the status of the home was in the past. And then these deductions associated with the rental use, so if you're paying to have the carpet steam cleaned or whatever else. Anyway, what is obvious from this graphic is that you get the most benefits if you can classify as principal residence. And obviously you do not see an asterisk by this exclusion of gain on sale of home, although maybe you should, because there is a limit to that, but you are protected to some extent on the gains you make from selling a house. That's your principal residence. Excuse me. Okay, so these are just some non-tax and tax things to think about if you are considering ownership, or anyone I should just say the generic, one should think about these things before a house is purchased. Obviously, it's a chunk of change, a lot of money. There's a potential you could make a lot of money on buying a house if the value of the house goes up a lot while you own it, especially since you're leveraged in that you own the house before you're actually paying all that much of it off. So that means that any gain on the sale of it would go into your pocket, not the bank's, even though they technically own more of it than you do. Obviously, risk of default, that's a cash flow issue. You're in charge of your own maintenance, and it's harder to move if you own a house and you are trying to sell or have to sell before you move. As far as taxes are concerned, your interest expense when you own a home is now deductible on that home loan. Your gain on the sale of the home is excludable, like I said, and I believe it's $250,000 if you're single and $500,000 if you're married, filing jointly. And then you have possibilities for rental and business use as well. Gain or loss recognized on the sale of personal residence is a capital gain or loss, so you automatically or would be typically at a lower tax rate already if you had to recognize it. No loss recognized is deductible because it's a personal use asset. All right, like I was saying, this is what the exclusion looks like. So if I buy a house for $1 million today and I sell it, I'm married, filing jointly. If I sell it for $1.5 million next week, well, actually that wouldn't meet the time requirements. But let's say I lived in it for 3 years and then sold it for $1.5 million. I would have gained $500,000 on the sale because it's $500,000 more than what I paid for it. I would not be taxed on any of that money. That would all be excluded from my taxable income. So that right there, I mean, if you are buying in a market that is appreciating greatly or you feel like it's going to appreciate, there's really obviously you have the non-tax considerations to think about, but there's not a lot of places you're going to be able to get the kind of return on your money that's tax-free. Well, I should say it another way. If you are pretty certain you're going to get a return on your money, it's very difficult to find a way to shield that money from tax as effectively as you can through buying a personal residence, assuming you can get that return. But of course, there are some ownership and use tests you have to qualify for. Taxpayer must have owned the property for a total of 2 or more years during the 5-year period ending on the date of sale. So during 2 of the last 5 years, the owner must have owned the property. So if the owner owned it multiple times, so let's say I bought it 5 years ago, owned it for a year, sold it for 2 years, bought it again, and owned it for another 2 years. Or let's say let's change that a little bit. Let's say I own the property for a year, sell it, someone else buys it, they own it for 3 years, I buy it back in the 5th year and own it for the last year. Okay, so I own year 1 and year 5 I owned it for. Because I owned it 2 of the last 5 years, I would meet the ownership test. Let's see. Oh, and either spouse, it doesn't have to be both, even if you're filing jointly, can meet that ownership test. Use tests. Taxpayer must have used this property as the taxpayer's principal residence for a total of 2 or more years during the 5-year period ending on the date of sale. Okay, so not only did I have to own it for 2 of the 5 years, but I had to use it as my principal residence. And this both, to get the full benefit, both spouses would have to qualify. So we would both have had to live in the house for 2 of the past 5 years, with it being our principal residence, to take full advantage of the exclusion. And again, I mean, it says in that 3rd bullet point that the purpose of that is to prevent using that as an investment tool, and that kind of goes against what I was just saying, that it could be a good investment tool. But I did qualify that by saying that there are non-tax considerations to consider. And what I meant by that is, okay, I have to, if this is gonna be a way that I invest and shield my money from tax, I would have to live in a house for 2 years, sell it, move, live in a new house for 2 years, sell it, move. Obviously, that gets tedious after a while. So, if that's not your cup of tea, obviously you wouldn't use that strategy. But if you can overcome the non-tax negatives, like I said, pretty effective strategy. At any rate, both husband and wife have to live, and again, it could be any of the last 5 years, but you can't say I lived here 1 year now and 1 year 6 years ago and use that. When Tyler and Jasmine were married, Jasmine moved into Tyler's home located in Denver, Colorado. Tyler had purchased the home 2 years before the marriage. After the marriage, the couple lived in the home together as their principal residence for 3 years before selling the home to move to Chicago. Tyler was the sole owner of the home for the entire 5 years he resided in the home. Would gain on the sale of the home qualify for the $500,000 exclusion available to married couples filing jointly, even though Jasmine was never an owner of the home? Yes, we didn't say that both had to be owners of the home. One of the two had to own it for 2 of the 5 years. Both of them have to live in it for at least 2 years. They lived in it 3, so they meet both tests. Those are some exclusions you can take a look at. They're uncommon, so I'm not going to get into them all that much. Yeah, again, this is not very common, so I'm not going to talk about that much. Interest expense deduction is one of the bigger reasons you hear a lot of financial advisors tell you, oh, it's a good idea to invest in your home and buy a house because gives you so many more tax benefits than renting. And it's actually a pretty complex economic calculation to determine whether it's more financially beneficial to rent or own. I had a professor in my postdoc program who had a spreadsheet that he did this for. He's a real estate professor in the University of Florida. And he had a spreadsheet, and you could plug in all these numbers and like rent and mortgage and interest rates and all this stuff. And it would tell you at what point in your living in this house would you break even had you owned versus renting. It was a pretty interesting spreadsheet, but there was a lot of components to it. And a lot more goes into it than people typically think. But yes, if you do own a home, this is a very important deduction because you are allowed to deduct qualified residence interest. And that just means that the residence is a qualified residence and the interest was used to purchase the residence. Or again, I guess I should say, or qualify that by saying the loan for the interest that you're paying the interest on has to be basically backed by the real estate. So it could either be purchase of the real estate where the loan, where the real estate is basically there's a lien on it and it would go to the bank if you defaulted on your loan. Same thing would hold true if you took out a home equity loan. So that could also be considered part of that. Yeah, I'm not going to talk too much about that. If you've ever dealt with home buying or been around it or familiar with it, you've probably heard the term points. And points is just typically just an upfront interest payment that you pay at the outset. You just call it a different name. This is basically identical to having to pay a premium on purchasing bonds. So if you pay a premium to purchase bonds, you upfront are paying more than the face value of the bonds, and what you're actually doing is paying some interest right up front. Same thing holds true here. You're paying interest up front to finance the cost of the home. Because of that, because of the fact that we're treating it similarly to how we treat premiums and discounts with bonds, in the same way, we're not going to recognize these points right away. We're going to recognize them, we're going to split them up over the term of the loan, amortize them, and recognize them as time passes on this loan. And again, in the current year, whoops. Let's see here. Oh, I'm sorry, I said that wrong. I guess I learned something too. Let me back up. I've forgotten that. Sorry about that, y'all. Okay, so what I messed up on was if you, okay, I'm remembering a little bit now. Points for the acquisition of an initial home. So if you're buying the house now and there's points on it, those can be written off or tax deductible right away. If there are points on a refi, then that is where you have to split it up and amortize over the period of the loan. So that's what you see with the differences here. Real property taxes typically are done through escrow. Yeah. So basically what's happening when you pay property taxes, the lender basically holds on to them and pays them for you. So it basically is done because the lender doesn't want to be left holding the bag if you move and haven't actually been paying these taxes. So the lender will typically collect monthly portion of your yearly taxes month to month and then pay those at the year mark. And you can write them off in their deductible, but you don't get the write-off until the money actually goes to the jurisdiction. Okay, so assume Tyler and Jasmine bought a new house on September 30th, 2016. Total property tax bill for 2016 is $7,000. The Jeffersons pay the full amount. Property taxes are calculated on a calendar year. What amount of property taxes are the Jeffersons allowed to deduct? Okay, so we have the $7,000, timing September 30th, so we got October, November, December. Okay, so these guys are getting screwed. That's the calculation I'm coming up with here. So they're only allowed to deduct the property taxes for the time period that they're in the house. And I guess the reasoning behind this is like it says here that we're assuming that you wouldn't be stupid enough to do this unless the seller compensated you up front and said, okay, here's 9 months worth of the property taxes that's been sitting in my escrow account. I'm going to transfer that over to you so that you can, when the year ends, you can pay for my 3/4 of the year when I lived here, and you only have to pay for the quarter you lived here. Now, if you didn't do that and you're too stupid to have thought of that or too new to the process and the people advising you are too stupid, then you're left holding the bag and you end up paying the whole thing and only get the tax write-off of the one portion. I guess the IRS says caveat emptor, I guess. Anyway, in this scenario, you would have just divided 7,000, yeah. Yeah, this slide's just wrong. That's why I was flipping back and forth here. Answer is not wrong. Well, let's see. Let me double check. I got 3. Yeah. So the calculation, they just don't really show you the calculation here. But basically, you take the 7,000 divided by 12 for the 12 monthly portion, and then multiply that times 3, and you get 1,750. Okay, so this is where you see a lot of people get audited and get a little bit of a slap on the wrist from the IRS. A lot of people like to claim part or all of their home as a home office expense deduction. But to qualify for that, taxpayer must use, obviously, or I would think obviously anyway, all of their home, or at least part of it, exclusively and regularly, as either the principal place of business for any of their trade or business. So, assuming you have more than one business, if your principal place of business is your home or some portion of your home, that's fine. Or as a place to meet with patients or clients in the normal course of your business. So if you're like a doctor and you have an office in your house and people come by and you treat them in your home regularly, or like a chiropractor and you have a chiropractic table in your garage and people come over and you work out of your garage, that's fine. Okay. So if you're well, that's pretty self-explanatory, so I'm not going to even explain that. Just look at that for reference. And that's the end. All right. So I sent you an email about the timing for the midterm and the nature of it. So pay attention to that. I'll send you out a reminder email that all of your homework and stuff prior to the midterm, prior to the midterm grade, is due the Tuesday of your spring break at midnight. But I'll send you that in an email.